Welcome to TechGolly Weekend News.
This week's top headlines. Biden administration launches probe on Chinese legacy chips before transition to Trump. Honda and Nissan announce historic merger talks amid Chinese EV competition. Google adjusts search results to comply with EU regulations, gaining airline industry support. Wuxi app tech to sell cell and gene therapy unit amid US restrictions. Albania announces TikTok ban following teenager's tragic death. Toyota faces declining production but record sales growth in November. Apple's share poised for record growth with AI-driven innovations. Bitcoin retreats amid end-of-year risk reduction despite MicroStrategy's continued investments. The Biden administration has initiated a last-minute trade investigation into Chinese-made legacy semiconductors. This move could lead to additional U.S. tariffs on these chips, which are integral to products like automobiles, washing machines, and telecom equipment. This Section 301 investigation is announced just 4 weeks before President-elect Donald Trump's inauguration on January 20th. Trump's administration will be responsible for completing the probe, potentially allowing it to implement the significant tariffs on Chinese imports he has repeatedly proposed. President Biden has already imposed a 50% tariff on Chinese semiconductors, effective January 1st, and has tightened export restrictions on advanced AI and memory chips and chip-making equipment to China. The administration also increased tariffs on Chinese solar wafers and polysilicon to 50%. The U.S. Trade Representative's office stated that the investigation aims to counter China's state-driven expansion in the semiconductor sector, which threatens market-driven competition. U.S. Trade Representative Catherine Tai highlighted evidence that Beijing's policies, similar to its strategies in steel, aluminum, solar panels, and electric vehicles, are geared toward achieving global dominance in semiconductors. She noted that China's subsidized chip production undermines competition by offering artificially low prices, putting market-oriented producers at risk. The probe focuses on legacy chips, which use older manufacturing processes in everyday applications, excluding advanced chips for AI and microprocessors. The investigation will examine the impact of imported chips and their use in critical industries, including defense, automotive products, and medical devices. It will also assess China's production of silicon carbide substrates and wafers. U.S. Commerce Secretary Gina Raimondo revealed that 2/3 of U.S. products utilizing chips contain Chinese legacy semiconductors, raising alarms about dependency and security risks. The U.S. has allocated $52.7 billion in subsidies to bolster domestic semiconductor production. Still, Raimondo warned that China's plans to build 60% of global legacy chip capacity over the next decade undermine these efforts. Tariffs on China are expected to remain a shared priority between Biden's and Trump's administrations. Honda and Nissan have announced plans to merge by 2026 in a landmark move for Japan's automotive industry. The move responds to the growing dominance of Chinese electric vehicle makers. The merger would create the world's third-largest auto group by vehicle sales, trailing only Toyota and Volkswagen. The collaboration seeks to combine resources and scale to counter competitive pressure from Tesla and Chinese companies like BYD. Mitsubishi Motors, partially owned by Nissan, is also considering joining and is expected to decide by January. Honda CEO Toshihiro Maebe cited the transformative impact of Chinese automakers and advancements in electrification and autonomous driving as key motivators. The companies aim for combined sales of 30 trillion yen, or $191 billion, and operating profits exceeding 3 trillion yen. Talks are set to conclude by mid-2025, and a holding company is planned for August 2026. With a market capitalization of over $40 billion, Honda will lead the joint company's board. Including Mitsubishi Motors would elevate the group's annual sales to over 8 million vehicles, surpassing South Korea's Hyundai Kia Group. Both companies have faced challenges in the competitive Chinese market. Honda experienced a sales slump despite strong motorcycle and hybrid car divisions. At the same time, Nissan announced plans to cut 9,000 jobs and reduce global production by 20% after poor performance in China and the US markets. However, Honda emphasized that the merger is not a rescue operation for Nissan, stressing that a turnaround is a prerequisite for success. Renault, Nissan's largest shareholder, has expressed openness to the merger, while Taiwan's Foxconn reportedly approached Nissan about an EV partnership but was rebuffed. Following the announcement, shares in Honda, Nissan, and Mitsubishi Motors rose. Former Nissan chairman Carlos Ghosn doubted the merger's potential, citing a lack of complementarity between the two automakers. Despite skepticism, Honda and Nissan maintain their existing partnerships with other automakers like General Motors and Renault on a project-by-project basis. Alphabet's Google has recently adjusted its search result formats to align with European Union tech legislation, known as the Digital Markets Act. This move has garnered approval from the lobbying group Airlines for Europe, which includes prominent members such as Air France-KLM and Lufthansa. Google has been rolling out various changes to its search results to balance the conflicting demands of different sectors, including price comparison sites, hotels, airlines, and small retailers. The latest set of adjustments was announced last month. In a letter dated December 20th to the European Commission, Airlines for Europe expressed their willingness to compromise to find a Digital Markets Act-compliant solution promptly. The group endorsed Google's proposal for a horizontal layout featuring same-sized boxes for airlines and comparison sites in search results, distinguishing them with the color blue from other elements on the page. They stressed the importance of consistency in prices displayed in search results graphics and boxes. However, Airlines for Europe raised concerns about Google's plan to use indicative dates rather than specific dates for flight bookings. They highlighted that exact dates are crucial for consumers looking for air travel and argued that this change could significantly degrade the user experience for consumers searching for flights. Google has indicated that it may revert to an older format of 10 blue links in search results if it cannot agree with its rivals, such as airlines and price comparison sites, on a compliant format that does not favor its products. China's Wuxi AppTech announced that its subsidiaries have agreed with US-based private equity firm Altaris LLC to sell its cell and gene therapy manufacturing division, Wuxi Advanced Therapies, for an undisclosed amount. This strategic divestiture comes as Chinese companies, including Wuxi, face increasing scrutiny and restrictive measures in the United States over national security concerns. The move follows a broader geopolitical trend where U.S. lawmakers have introduced measures to reduce American reliance on Chinese firms in critical sectors like pharmaceuticals and biotechnology. In September, the U.S. House of Representatives passed legislation barring federal contracts with specified Chinese companies or entities conducting business with them. These measures aim to protect Americans' personal health and genetic data from potential foreign exploitation, while encouraging domestic companies to source and manufacture drug ingredients and conduct early-stage research within U.S. borders. In addition to selling Wuxi Advanced Therapies, Wuxi AppTech disclosed that it will also divest Oxford Genetics, its UK-based subsidiary within the Wuxi ATU business, to Altaris LLC as part of the agreement. This dual sale underscores a strategic pivot for the Chinese pharmaceutical giant as it navigates growing restrictions in international markets. Neither Wuxi AppTech nor Altaris LLC commented on the transaction's financial details or broader implications. The sale reflects the ongoing adjustments global firms must make to adapt to shifting regulatory and geopolitical landscapes, particularly in sectors tied to advanced medical research and technology. The deal is expected to have significant implications for Wuxi AppTech, allowing the company to streamline its operations amid rising global challenges. At the same time, Altaris LLC, a major player in healthcare investments, may leverage these assets to expand its cell and gene therapy manufacturing footprint. Albania has decided to implement a one-year nationwide ban on TikTok starting early next year, citing concerns over social media's influence on children. Prime Minister Edi Rama announced the measure following nationwide consultations with parents and teachers. This decision comes in the wake of the tragic killing of a 14-year-old boy in November, which has raised alarm about the role of social media in fueling violence among youth. The ban is part of a broader initiative aimed at making schools safer and addressing the rising impact of social media on Albanian children. According to Rama, TikTok has played a significant role in exacerbating youth violence, both in and outside of educational settings. His statement emphasized the broader societal responsibility of protecting children from the adverse effects of digital platforms. The incident that triggered this decision involved a fatal stabbing during a dispute between two schoolboys linked to social media disputes. Following the tragedy, videos surfaced on TikTok showing minors endorsing the violent act, further heightening public concern. Rama directly criticized platforms like TikTok, stating that they are taking our children hostage and contributing to a societal problem that demands urgent action. This move aligns Albania with other nations, such as France, Germany, and Belgium, which have also restricted social media use for minors. Stricter measures are being adopted globally, with Australia recently enacting a comprehensive social media ban for children under 16. Meanwhile, TikTok has yet to comment on Albania's decision. The government's firm stance underscores the growing concern over the influence of digital platforms on young minds and reflects an urgent effort to address the societal consequences of online interactions. Toyota Motors' global production declined for the 10th consecutive month in November, with the world's largest automaker reporting a 6.2% drop to 869,230 vehicles compared to the same month last year. This decline is sharper than October's 0.8% decrease. Despite these setbacks in manufacturing, Toyota's global sales climbed for the second consecutive month, increasing by 1.7% to 920,569 vehicles, setting a new record for November. Toyota's production fell by 11.8% in the United States, reflecting a slow recovery. The resumption of Grand Highlander and Lexus TX SUV production in late October, after a 4-month halt, contributed to mitigating further declines. In China, output dropped by 1.6%, showing improvement from the previous month's 9% decrease. Increased local sales of the Granvia and Sienna minivans and the BZ3 electric sedan, developed in partnership with BYD, bolstered regional performance. Amid growing competition from BYD and other Chinese brands, Toyota plans to strengthen its electric vehicle strategy in China. According to a Nikkei report, the automaker will build an independent Shanghai plant by 2027 to produce electric cars for its Lexus luxury line. Japan, contributing approximately a third of Toyota's global production, saw output drop by 9.3% in November. This was partly due to a 2-day production halt at the Fujimatsu and Yoshiwara plants. From January to November, Toyota's global production decreased by 5.2% year-over-year, totaling around 8.75 million vehicles. During the same period, global sales declined by 1.2%. These figures encompass Toyota's Lexus brand vehicles, but exclude those produced by its group companies, Hino and Daihatsu. However, Toyota's efforts to adapt to changing market dynamics, particularly in the EV segment, signal a proactive approach to sustaining growth amid increasing competition. Wedbush analysts, led by Dan Ives, remain bullish on Apple Incorporated, forecasting a golden era of growth driven by advancements in artificial intelligence. In a note to clients on Thursday, the analysts raised their price target for Apple shares to $325, up from $300, indicating a 26% upside potential from the stock's intraday price of $258.25. Maintaining an outperform rating, the firm pointed to a multi-year iPhone upgrade cycle propelled by AI capabilities, which they believe the market underestimates. The revised target substantially exceeds the $244 average price target compiled by Visible Alpha, which implies a decline from Thursday's levels. Among the 15 analysts polled, 9 hold buy or equivalent ratings for suggest, hold, and 2 have sell recommendations. Wedbush's optimism about Apple's stock growth is based on its projection of over 240 million iPhone units sold in fiscal year 2025, marking a historic peak. Apple's stock touched an all-time high on Thursday before retreating slightly in early trading, reflecting its impressive growth trajectory. The company's shares have risen over 33% year-to-date, pushing its market capitalization close to the $4 trillion mark. If achieved, Apple would become the first company in the world to reach this milestone. Only 3 firms, including Apple, Nvidia, and Microsoft, boast market capitalizations exceeding $3 trillion. Wedbush analysts highlighted Apple's sustained dominance in consumer technology and its ability to innovate in AI and hardware integration as key factors driving this historic valuation. The transformative potential of AI-driven features in upcoming iPhone models could redefine user experiences and further solidify Apple's market leadership. Given the anticipated growth cycle, Wedbush envisions a landmark year for Apple, setting the stage for record-breaking iPhone sales and sustained investor confidence. Bitcoin experienced its first decline in 3 days, dropping by as much as 3.4% to $95,110 in New York on Thursday. This retreat comes after the cryptocurrency hit an all-time high of over $108,000 on December 17th, marking a significant pullback as traders reduce risk exposure ahead of the year's end. A broader index of cryptocurrencies, including Ethereum, Solana, and Dogecoin, also saw a decline of approximately 3.5%. According to Zahir Ebtekar, founder of crypto fund Split Capital, the dip reflects a combination of year-end and holiday-related de-risking. The $100,000 level is a psychological barrier for institutional investors seeking to lock in gains. The decline in Bitcoin's value came despite bullish news from MicroStrategy Incorporated, the largest corporate holder of Bitcoin, which announced plans to expand its Bitcoin buying program. The company, which holds over $40 billion in Bitcoin, revealed in a filing with the U.S. Securities and Exchange Commission its intent to increase the number of authorized shares of Class A common stock and preferred stock. This move aims to bolster its financial capacity to purchase more Bitcoin, reinforcing its pivot from a software company to a leading cryptocurrency investor. Earlier this week, MicroStrategy reported a $561 million Bitcoin purchase at an average price close to last week's record highs, marking the 7th consecutive week of acquisitions. Market analysts, including Sean McNulty of Arelos Markets, credit MicroStrategy's consistent buying activity as a primary driver of Bitcoin's rally throughout the year. Bitcoin's impressive 130% rise in 2024 has outperformed traditional investments such as global stocks and gold, yet the market faces potential turbulence. On Friday, derivatives exchange Deribit will see a record $43 billion in open interest expire, including $13.95 billion in Bitcoin options and $3.77 billion in Ether options. Analysts warn that these expiries could result in heightened market volatility, with market makers potentially unwinding hedges and shorting Bitcoin, creating choppy trading conditions to close the year.